Okay, welcome to the Pinnacle Income Masterclass Series luncheon. It's fantastic to see so many of our long-term supporters here in the room today, especially after the week we've had in markets. For those of you who don't know me, my name's Mark Cormack. I'm a director with Pinnacle Investment, but more importantly today, I'm your host and MC for today's session. In terms of background, for those of you who don't know Pinnacle that well, we're equity partners and work alongside some of Australia's leading fund management groups. So what do we do differently at Pinnacle? We're a house of boutiques fund manager. We provide the initial capital and infrastructure around some of these leading fund management groups that you can see here. We do all the non-investment related services, things that can often distract a fund manager from doing the things that they do best, which is manage money and provide innovative investment solutions for you and your clients. In terms of that, we do things like sales, HR, legal, compliance, fund accounting and marketing. And today, I'm absolutely delighted to have two of the very best fund managers in the income space with Metrics Credit and Plato to take you through their innovative approach to investing for income. Our journey at Pinnacle started in 2006 and we've now grown to be managing over $61 billion in funds under management. And in terms of the fund managers we've attracted to our group, we now have fund managers managing money across all different asset classes, and you can see there's 15 different groups there. But importantly, with each of those groups, the fund managers own the majority of equity within their boutique. So turning to today, income investing is always a hot topic, especially in a lower for longer interest rate environment. And today's first speakers, Plato, are a fund manager who've really challenged the norm with regards to income investing by establishing an objectives-based income solution in global and Australian equities. Plato do something very different because they're managing money specifically for low-tax investors, which is different to most other fund managers who are managing money for clients in all different tax brackets. In terms of that, Plato can do things such as be more active around dividends. CGT is no issue for low tax investors, or they can participate in off-market buybacks because they're very tax effective for low tax investors. In terms of Plato, they've been able to deliver over 9% income in Australian equities and over 6% income in global equities, which is a traditional low yielding asset class. And along the way, they've won Fund Manager of the Year awards with Lonsec for most innovative solutions. With that, it's always a great pleasure to introduce Dr. Don Hamson. Don is the founder and managing director of Plato. Don was one of the very few fund managers who really took on the ALP's franking credit policy last year in the election campaign. And during that campaign, he was known as the protector of the pensioner. But around the office, he's known as the Justin Bieber of the Blue Rinse set. Please make him feel welcome, Dr. Don Hamson.
I'm never quite sure whether to take that last comment as a positive or a negative, actually. So, but anyway, I'll take it as a compliment. But yeah, I'd like to welcome everybody, particularly on a day like today. I mean, the weather's horrible, and Andrew and myself, actually from Metrics, have got a few umbrellas out the back there. So if anybody who got wet on the way here, we've got some decent umbrellas that you can pick up on the way out if your umbrella got blown out or something. So. But yeah, thanks for that. Now, one more piece of housekeeping. Has anybody recently returned from Iran? Seriously, though, coronavirus is everybody's thinking about it. To me, though, look, the panic is worse than the pandemic, and the pandemic isn't great. It is the flu, but it's got a much higher fatality rate. But that fatality rate is very much for older people or people with problems. We've had 2 deaths in Australia. We don't want 2 deaths, but one was 78 and one was 95. So the statistics, we've been following this very closely, are that if you're under 50 and you're healthy, there's a very, very low probability of you being seriously affected. So it is the flu, it is a flu-like thing. Flu come and go, and there are vaccines on the way. So there are already 2 vaccines being developed in the world, one of them here in Australia from University of Queensland. They're currently being tested. So everything's happening faster, the spread's fast these days, but so is the response. We've also seen policy response. I'm happy to say we called this presentation lower for longer. We can now say it's probably even lower for longer because Australia's already cut its rates 25 basis points, the Fed cut by 50 basis points, and Bank of Canada overnight, if you hadn't heard, cut by 50 basis points. So we have concerted easing around the world, and we'll probably see more policy response, hopefully some fiscal response as well. So our headline name for this thing is still intact. It is still lower for longer. Got a number of things to go through today. So talk about why retirees are different. We manage money for retirees. We want an award for it. We'll look about investing in equities for both growth and income. People think about it for growth, but it's also for income and for growth in income. Bit of an update on Australian shares, including a little bit of a quick, our quick first summary of the Australian reporting season and potential for coronavirus impacts. And then lastly, looking at global shares and how you can get good income from global shares. So, who is Plato? For those of you who don't know Plato, because there's a mixed audience here, and many of you are familiar with us, but some aren't. Plato was one of the first boutiques, in fact, the first new boutique from the Pinnacle Group. We were founded in 2006. We did have over $6 billion under management until the last week or so, but over $5 billion in assets under management. And we specialise in income investing, and indeed we won an award a number of years ago for retirement product innovation, because believe it or not, we still have one of the only funds in Australia which has been designed bottom up for retirees, and thankfully they can continue to keep those franking credits, because one of the differences of retirees is in fact that their tax rate. It's not all about me. You see me up here all the time. We've got a couple of the guys in the audience, but there are 11 in the team. We have 5 PhDs. Highly qualified and highly experienced. I mean, I've been doing this sort of stuff for well over 20 years, but the average team experience is 18 years. So, there's a hell of a lot of experience, and, we've all been through the GFC, everyone in the team. And all of the senior guys have equity in the firm that aligns the interests with yourselves and your clients. And most of us are actually invested in the fund, even though none of us are yet retired. And you also get the benefits of the Pinnacle Group. There's a lot of the Pinnacle people here that Mark and Amelia and Ed and Simon and other people are here who can also help you out. So that's us. Why are retirees different? Because, most of us here in this audience, we're in the accumulation mode, saving up money, but when you retire and when you no longer get that monthly salary, you have to replace it. You live off the earnings from your investments. Our focus is delivering consistent and high levels of income, whether it be from global shares or Australian shares, but also focusing on the tax difference, because tax-exempt investors, and so thankfully they still do get those refunds of franking credits, we manage from their tax perspective. Also, the other thing they're facing, or retirees are facing these days, is longevity risk. We are living longer, and the other problem is lower for longer. Interest rates are just getting smaller and smaller. And indeed, this slide is now out of date. This slide is to the end of December. This is the real earnings after allowing for headline inflation on $1 million. And this line here is zero. And in fact, I just updated this slide this morning because somebody said, what does it look like after the last 25 basis point cut? Well, it's another $2,500 lower. If you have your money in overnight cash, or basically in 10-year government bonds these days, after inflation, your $1 million is worth $13,000 less at the end of the year. And that assumes you're a retiree that's not paying tax. If you pay tax, it's even worse. So if you're sitting in lazy cash, or even a government bond, which is now 70-something basis points, you're actually losing about $13,000 after you take account of inflation. That ain't going to fund a decent retirement. You are going to run out. And yes, it's got worse. We have seen the first 25 basis point cut, and now people are wondering when the next one is, because the Fed's already gone 50, Bank of Canada's gone 50. People are factoring in at least one more cut here in Australia, as well as potentially other factors. So it is just getting harder and harder. And, this is not new, but coronavirus has just reinforced that. The chance, or the likelihood of a recession is certainly significantly higher now than it was 3 months ago, given coronavirus and bushfires. And that just means interest rates will be lower for longer. And longevity risk, the problem there is, particularly if you can't access the pension, if you have other assets, holiday homes that don't give you income, $1 million is probably not enough for retirees if they are investing in safe assets. You probably know that, but you'll run out of money before you expect to die. But if you can lift up and go into a balanced fund, and this is what you tell your clients, if you can increase that return to something like 3 or 4% real, you should be fine. We all know that, but it's a struggle telling clients, particularly when markets fall 10%. Thankfully, franking credits are still around, and I think this slide just highlights the importance of franking credits. You might think, oh, it's only 1 or 2% a year. It's about 1.5%, 1.6% per year on the index. But if you compound that out over time, it makes a huge difference. So here's nearly 14 years. We're using the tax-exempt indices from S&P for the ASX 300. We're looking first at the price index in dark blue, the accumulation index, which just includes cash dividends in light blue, and then we look at their tax-exempt index, which includes cash dividends plus the franking credits. And over the last 14 and a half years, prices have gone up just under 3% per annum, which is not a lot. The accumulation index with cash dividends only has gone up 7.5% per annum. But if you add that inflation in, you're almost got to double digits. It's over 9%. And the beautiful power of compounding means that, in fact, the Australian equity market, after including franking credits, has gone up 250% over the last 14 and a half years, whereas the price index has only gone up 50%, just over 50%. So income is incredibly important in Australia, far less important in, say, the US. The other way that we look out for buybacks, and there's an interesting thing, those indices don't include buybacks. They don't include the franking credits in buybacks. They also don't include special dividends, which is interesting. And we are on the lookout for special dividends for our clients and buybacks, such as 2018, end of 2018, BHP's buyback, which was worth more than 20% for a tax-exempt investor like a retiree, because they fully value the franking, they get a full refund, and so they would have made more than 20% for every share they successfully tendered, or that we tendered on their behalf into the BHP buyback. So we look for these opportunities, and there are a few more around. Even this year, Qantas announced a small one in the latest reporting period, and there's some pretty good indications that CBA might be doing something mid-year when it sells some of its assets, because it's got the only bank that's really got excess capital. Mentioned before, we'll also quickly rerun some slides that, if you're familiar with our presentations, you will have seen this, but we update this every year, so it's got another year added to it, which is we're looking at, first slide here is looking at the available yields on the Australian market. And again, these are to the end of December, so take another 1/4 basis point off, 1/4% off the yields here on cash and bonds and term deposits. Australian equity market's been pretty consistent. That's the grey line, including gross dividends, around 6%. And the gap between the available yields on cash-like investments or safe investments and Australian equities, grossed up for franking, has never been bigger. The RBA is encouraging your clients, investors in general, to invest in riskier assets to get real earnings rather than having lazy cash. And they are being rewarded for that in terms of income. Obviously, there is volatility along the way in terms of prices. This slide, however, doesn't give you a good picture of how you would have went if you'd invested there. And I also call this slide and the next two the history of my parents' retirement, because they retired in 1980, and really they had two things they invested in, cash or equities. So let's have a look at how my parents would have gone if they'd put $100,000, which is a fair bit of money back in 1980, either into shares or into cash. Now, the analysis that I'm doing is interesting because I'm doing it from my parents' perspective, because they retired in 1980. What did they do? They lived off the income from their investments. So the way I've done this analysis is they live off the income, whatever they get from their shares or their cash, but they do not touch the capital. And that's what a lot of investors don't want to dig into, the capital. So let's see how they went. Well, the black line or the dark blue line here is the interest that they would have got on their cash, 100,000 cash. And it was a pretty good time. You got double digit. You got more than $10,000 initially, 10 to 15 or more $1,000 in the 80s, because interest rates were high. But now you're getting, quite frankly, bugger all. If you've been disciplined enough not to spend the 100,000 in cash. But here's an interesting one, and the maths are correct, but that light blue line, which now goes to over 70,000, is the income from an initial $100,000 Aussie equity portfolio, just an index fund. I've just used the index. I haven't picked CSL or the best stock in the index. This is just the index, the All Ords / spliced with the ASX 300. And when the franking credit index, it does include franking credits, and that's pretty tremendous. Chalk and cheese, 70,000 versus like 1,000. And some people say, how does that actually work? Well, I think the next slide puts it in perspective or makes you understand it, because the $100,000 initially for the share market is now about over $1.2 million. The Australian equity market over the last 40 years has gone up more than 12 times. So your initial 100,000 that you haven't touched and you haven't put any money back into it, it's just the capital per se has gone up 12 times. So you've now got a much bigger investment, and 6% of 1.2 million is 70 grand. So it makes sense. Of course, your 100,000 in cash is still 100,000 if you have had that discipline not to spend it. We've also done some other time periods, haven't got time to go through them, but they highlight some of the worst times to have invested in the share market, and you've still generally gone up. It also does highlight the volatility that, yes, share prices go down. The GFC highlights that. And we might have a down year this year if we have a recession or what have you. And we had a little bit of a down year around here, which is the recession we had to have, but that's pretty much faded away. But so there is volatility, and I'll go backwards, but you can also see that volatility in the dividends, but that is not nearly as big a fall in the GFC in dividends as there was in capital. Dividends tend to be more stable than the underlying capital. So to me, these slides together are great slides to show your clients to talk about the reason for investing in equities. Even if you're retired, and my parents, well, my mother was retired for not quite 40 years, but nearly 40 years. That's a long time. And anyone, retiring today, there's an expectation you're probably going to live, or someone in a couple is going to live 30, 40 years. So you are investing for the longer term. Yes, there's some ups and downs. These slides highlight the ups and downs, but they also highlight investing in equities, where you invest for growth in both capital and income. Quick update on how we get more income. Now, all those slides are on index. Index gets 6%. In Australia, we've been able, in our Australian Shares Income Fund, we have been able to generate over 9% gross income after fees, year in, year out, distributed to our clients. So that's a much higher level than the index, and that's after our fees. How do we do it? Well, the index pays a certain amount of dividends. If last year you owned the index, this would have been the dividends you got and by month. And basically, well, it's when they go X. This is plotted by the X date of stocks, but essentially that's when they go. Some go X in February, some go X in March, some go X in May and August and September and all across the year. Now, that's an interesting one. I had a look at this slide yesterday and I almost thought, gee, we've stuffed this up, because there's an interesting one here, and it's a trick question. It's certainly an umbrella for anybody who can get this question, apart from Peter, because you know. Why does the index have, because the grey bits are franking and the blue bits are cash dividends, why have we got a chart that says there were some franking credits in January last year and no cash dividends? And we haven't made a mistake. We've just taken it from the index, from S&P. Anybody going to hazard a guess? No, it wasn't a buyback. They don't even include buyback ones. Actually, it is a trick question, but S&P's methodology is they do not include special dividends as dividends. They include them as a return on equity, a return of capital, and BHP paid a very large special dividend in January last year, or when X. But S&P say, well, hang on, we've got to account for the franking credits in this franking credit index. So they accounted for the franking credits, but they didn't account for the massive cash, $7 billion cash dividend that BHP paid out. So it's a bit of a trick question. But anyway, that's the pattern. What we do is we actively try and get more of those dividends than the index by actively trading our portfolio. So we were overweight BHP to get more of that special dividend. We were overweight BHP again in February when it had its ordinary dividend. And we move in and out, and we were overweight CommBank last year, and then we moved to other stocks later in the year. So we trade between these dates to get more of each one of these dividends and then more of that one. And by actively trading our portfolio, we capture more income and more franking credits. But the beauty of this strategy is we don't have to be overweight all the banks all the time to get more income. We can move in and out between the banks, so we're not overweight banks, and that's a good decision for the last few years because banks have had some pretty ordinary performance. So we haven't been hit like many income providers or funds that are overweight banks for much of the year. And the beauty of this strategy is really, I think, in this next slide, a little bit hard to understand, but just think about it. It is relative performance, so performance relative to the index over time, but as you move into this line 0 here is the ex-dividend date of a stock. So it looks at the performance of all dividend-paying stocks in the Australian market for basically 20 years and looks at how performance moves as one moves in towards the next dividend date. And because these lines are moving up, stocks in Australia that pay dividends have a tendency, not every one, but have a tendency on average to go up relative to other stocks before they go ex-dividend. And that's brilliant for our strategy because we want to buy the stocks to get their dividends, so we buy them here and they tend to go up and we get some outperformance and we capture the dividend, we hang it on till the ex date, we get the dividend entitlement, the franking credit entitlement for our clients, then we reevaluate and move into other stocks where we see other dividends. Or if we really like the stock, we stay there. And this is how we can get more income in the market without being overweight the banks and other high yielders. And it means we can still actually have CSL in our portfolio. So we rotate through stocks to capture the dividend and the franking and that tendency for stocks to run up. And that's how we get sustainably more income. But like all fund managers, we want to look at valuation of stocks. We look at the quality of stocks. There's no point in buying horrible stocks. We want stocks with good business momentum, but I think a very important point, and we say this every time, is you also want to buy a stock that's going to pay a dividend. So just beware, and particularly, I think, in the environment we're moving into, with coronavirus and industries and stocks being affected, that many stocks might look attractive, but they may be dividend traps. You want to buy a stock for its income, but you want to make sure it's going to pay it, particularly if you buy it a couple of months before it announces its results. Because we don't want to buy AMP a year ago, and then it comes out and says we're going to cut the dividend, we're going to cut it again. And AMP, we've been using this for a while, but it's a classic case of a dividend trap because, very simple chart. Share price on this side in the grey line, and share price of AMP has largely fallen for the last couple of years. Apologies for anyone who works for AMP, particularly if you have shares in it. But funny enough, on this side we've got gross yield, and that's the dark line. And as the share price was falling heavily, particularly in 2018, the yield actually went up. And went up because what is dividend yield? Dividend yield is dividends paid over the last 12 months, usually defined as historic yield. Dividends paid last 12 months divided by current share price. So if the share price goes down, the yield goes up. That looks attractive. I could have bought AMP on 13 or 14 or 15% gross yield. Except that dividend cut, no dividends at all. And by the way, the share price has fallen. So classic dividend trap. It's not the only one. We could have used New Farm, we could have used Blackmores, could have used a number of stocks. Adelaide Brighton's been the same boat in that sort of thing. So beware the dividend trap. I mentioned before, we've been able to, since inception, deliver more than 9% gross income after fees. In fact, 7% cash yield, 2.7% franking credit yield. That is substantially more than the index's 1.5 franking yield. So you can see a lot more franking, but also a lot more cash dividend. Remember, that is after our fees. So we've been able to do that year in, year out. Just looking, and we can touch a bit more of this in Q&A as well, but latest reporting season. It wasn't great, wasn't fantastic, but it wasn't a complete disaster. There were some good results from the likes of JB Hi-Fi. They did the same thing last year and the year before. They actually have bucked the retail trend. Some good results from CSL and ResMed. Iron ore miners, we've been saying they've been very profitable, paying great dividends. They continue to do so, and iron ore price is still pretty high. CBA, solid result. Not a great result, but they haven't cut their dividend, the only bank not to. And as I mentioned, they've got excess capital. The only bank have excess capital, so a pretty good result there. But there's some negatives, mentioned AMP, Blackmores, even before the effect of coronavirus. Blackmores had a horrible result and didn't pay a dividend, and they've also said, look, we probably won't make virtually any earnings this half year because Chinese tourists are not coming and they're not going home with a bag full of Blackmore vitamins. And that's a big selling thing for them. I mean, it's true, they make a fortune out of those. I mean, you go down to any of the tourist shops down the quay and they got half the shops full of vitamins and, you know, milk and A2 milk and things. So overall, the result, the dividend period was pretty flat, really. And in fact, I think the median's probably the best way of looking at it. The median dividend this year, this last half year, was the same as last. So pretty much dividends are about flat. If you exclude all the big specials that were paid last year, you could actually make a positive thing and say actually dividends went up a bit. But the reality is clients, you know, it's dividends in their hand they look at. So they're pretty flat based, you know, this year versus last year. And remember, that's just stocks that were reporting in the month of February. And in terms of outlook, yeah, Blackmores, Cochlear. You may not think, how's Cochlear affected by coronavirus? Well, about 20% of their sales are into China. If you have a cochlear implant, you have to have a major operation. They inject it, you know, insert it into your ear and blah, blah, blah. There are no elective surgeries pretty much happening in China this year because the hospitals are full with people with the virus. And if that spreads worldwide, that could impact their sales this year. But the virus is temporary, flu's temporary next year. People will still want to have those implants. There'll be some catch-up. Anything related to tourism is pretty obvious. Treasury wine's big market into China as well. So, you know, we know some of the obvious ones. So it is going to get tough, and avoiding the dividend traps is going to be even more important, I think, in the next 6 months. Which brings the question of diversification is one way that you can reduce your risk, whether it be from coronavirus or everything else. Make sure you have a well-diversified portfolio. Don't just have one or two income stocks. If you've been in the banks and Telstra the last couple of years, you will know, or your clients have individual holdings, they'll be feeling the pain because those stocks have underperformed the market big time. And Telstra, I mean, 3 of the 4 banks have cut their dividends by about 15%, or ANZ just by the franking level. Telstra has cut its dividends 48%. In fact, if you've seen this slide, and we do this every year, you might say, well, hang on, isn't Telstra one of the 6 biggest dividend payers in the Australian market? Well, it isn't anymore because it's cut its dividends so much that it's no longer in the top 6 dividend payers by dollar value. It's been overtaken by Rio. But it just highlights, that pie chart highlights the lack of diversification in Australia. It is now the case that 4 banks and 2 iron ore miners pay half the dividends in Australia. Now, we like the iron ore miners. The banks, not so much, but they're cheap, but they've obviously got some headwinds in terms of their earnings for the short term. This chart, I think, highlights why you need to be better diversified. So 1, we hold a diversified portfolio of around 90 stocks in our income fund. We are not overweight the banks, and we're not, I don't think, currently overweight Telstra. So, but the other way of diversification is overseas diversification. Global shares, you get currency diversification, and our currency is declining, but also, look at that pie chart. The top 6 dividend payers globally represent less than 10% of global dividends. They are quite small. So even there, you can immediately see, yes, better diversification. And you probably can't read the names there, but you've got Exxon, you've got AT&T, you've got Apple and Microsoft are actually in the top 6 dividend payers, interestingly. Low yields, but they're big companies. There are 2 banks this year, HSBC and JP Morgan, although I feel that there will only be 1 next year because I have a feeling HSBC may not be in there next year, or this year. But much better diversification, and there's a few names on the right-hand side of stocks we've held in our portfolio. And indeed, we've been able to generate around 6%, just over 6% after fee income from our global shares portfolio. And you might think, well, how do you do that? That's pretty hard because global shares, they're not income related. Well, if you start looking for income, there's plenty. And indeed, we also do a summary every quarter of dividends. And last year, global shares increased their dividends by more than 10%, actually 11% in Australian dollar terms, to over 2 trillion Australian dollars of dividends was paid globally. There's a lot of income from global shares, and it's growing. And there is a huge number of stocks globally paying dividends, far more, way more than we have in Australia. In fact, in January last year, when BHP, I think, was the only stock, and it was a special dividend, that paid a dividend to WNX in January last year, there are about 400 companies in other countries that paid dividends. So there's a lot more diversification, and indeed, March and September, you've got nearly 2,000 stocks paying dividends. So the world certainly is your oyster. It's our oyster in terms of the opportunities to receive dividends. And also, there is the same opportunity to capture that run-up, that tendency for dividend-paying stocks to outperform a little bit as they approach their ex-dividend period. And indeed, the red line, the black dotted line is Australia. The red line is German stocks. German stocks pay a single annual dividend, and they tend to have quite strong outperformance in that month or so or three before they go ex-dividend. So that is how we've been able to generate consistent levels of high income from global shares. And the interesting thing is in our global shares income fund, which is a differentiation from our domestic one, is because we receive dividends and quite a lot of dividends each month, we actually pay out those dividends each month. And this chart here shows the monthly distributions. They are lumpy because some months have a lot more dividends than others. We just pay out what we've got. This chart, the light blue line is the yield of the index, and the dark blue line is our excess income above and beyond the index. And you can see we have substantially more income in each month, and we deliver it monthly. So for clients, many clients value getting income monthly. Our Australian fund doesn't distribute monthly, it distributes quarterly, but we do have a listed vehicle, some of you have probably invested in, or your clients, called PL8, or ticker PL8, Plato Income Maximiser, which also pays monthly dividends. So you can get that from our Australian opportunity as well as from the global. So just summing up, we didn't expect a coronavirus when we put this on and we picked the title of Lower for Longer, but it just reinforces that we believe income from traditional sources is getting tougher and tougher to get, and so it is certainly a case of interest rates being lower for longer, in fact probably much lower than we thought. Hopefully we've been able to show you that by investing in a diversified portfolio of equities, whether it be Australian equities or global equities, that you can get diversification as well as good income and some capital growth. And we have a consistent track record of delivering high yield for our investors. So that is all it is from me. We've got a couple of vehicles there. I'll hand back to Mark.
Thanks, Don. And just to remind everyone, I'll have the opportunity to ask questions at the end. Okay, look, next up we're going to change tact and we're going to look at fixed income from the income side of things. And I'm absolutely delighted to introduce Metrics Credit. Metrics Credit provide a portfolio of corporate loans, and it's only a relatively new asset class that's been made available to retail and advisors here in Australia. It was the privy of institutional and superannuation funds who could access this prior to Metrics Credit launching the MCP Master Income Trust, or MXT as it's commonly known, on the Australian Stock Exchange over 2.5 years ago. In terms of Metrics, who are they? Well, they're Australia's leading non-bank lender to corporate Australia. They're also the largest fixed income have the largest fixed income offering on the ASX with the MCP Master Income Trust. They also have another offering, the Metrics, or the MOT, which is the Metrics Income Opportunities Trust available. So what's the outcome of investing with Metrics in a portfolio of corporate loans? Well, it provides you with capital stability and it provides you with consistent monthly income. Metrics lend to a wide range of corporates in Australia, large ASX listed companies. They lend to project and infrastructure companies. They lend to large real estate projects, and they also lend to unlisted or private companies. In terms of Metrics, they're incredibly selective in who they lend to. Most loans that pass their desks don't pass the filter that they put through, but importantly, when you look at their portfolio of investments, they've never had a negative month. So with that, I'd like to introduce one of the managing partners and founder of Metrics Credit, Andrew Lockhart, to take you through their innovative solution and how to manage money in the fixed income space for income. Please welcome Andrew.
Thanks, Mark. Thanks, buddy. Thanks, man. Thank you, everyone. For those that have not had any exposure or experience to Metrics, a brief introduction. Metrics Credit Partners was a business that was established back in 2013 when we launched our first fund. So myself and my 3 other partners launched the business back in June of 13 with one single financial product for investors, providing investors with exposure to private market loan assets. Since then, the business has grown substantially. We have now well excess of 60 people in the business, with premises and offices in Sydney, Melbourne, and now in Auckland. Our business is very much focused around direct origination and the risk management associated with directly lending to companies. As Mark mentioned there, the 4 key markets that we cover are loans to both private and publicly listed corporates. We're active as a financier to project and infrastructure related borrowers, commercial real estate, both development financing for private developers and also real estate investment trusts. You'll see here a range of logos that cover those 3 areas, and another key part of our market that we access is loans to private equity sponsored operating companies. So as a business now, since June of 13, we've completed in excess of 8 billion of transactions, over 300 individual transactions across a range of both investment grade and sub-investment grade exposures. So we've seen substantial growth, and it's been pleasing the support that we've been able to gain from investors as we've built our business. I think it's interesting when we talk about income and generating income from asset classes. It's interesting that often, there are a couple of things that people always say about fixed income, or the yields are unattractive or low, or that it's difficult to gain exposure to a diversified portfolio, or the risk is asymmetric. As a private lender, I would say a lot of those things are incorrect. So from our perspective as a lender, our skill set is about going out, building relationships with companies, seeking to develop those relationships and originate transactions for the benefit of our investors. If you think about it in the context of a market, you've got public market securities investors, say an equity investor or a bond investor, that is generally a passive buy-side investor. You think about the equity manager, they haven't been involved in bringing the IPO to market. Or if you're a bond manager, you've tended not to originate the transaction. You've bought the bond based on a price and a credit rating that's been delivered to you through an intermediary. In our business, we're private markets operators where the skill set requires you to go out and hunt and find those opportunities to lend to companies. And so across our spectrum, we believe that when we look at the universe of the companies that we lend to, you can find opportunities where the risk and the return relationship changes. And as a result of being an unregulated lender, a non-bank lender, I guess we have the fortunate benefit, of also having a range of options that are available to us in circumstances where credit quality might deteriorate. So if you think about in circumstances where credit quality might deteriorate, you need a manager that's going to roll up their sleeves, go through the workout process, go have the experience to do a corporate restructure to protect and preserve investor capital to the downside risk of loss. So when I look at this asset class, you look at the particular areas where you sit, and the income that can be generated from corporate loans is very appealing, considering where you also sit in the capital structure. Obviously, other asset classes will expose investors to greater volatility of capital, so the stability of their capital might be impacted. So if I think about investing in say, equities for income, the volatility that you're exposed to associated with investing in income or investing in equities for income is something that should not be present for an investor investing in debt generating income. Our asset class, particularly in direct performing loans, isn't going to provide investors with significant upside participation. The underlying loan assets should provide for stability of capital, and it's a contractual obligation imposed on the borrower. So if I look at the traditional sort of ways in which investors have sort of thought about asset classes, the one on the left, it's a fairly traditional type of approach: cash, Australian bonds, international bonds, showing a risk and return process or available risk and return outcomes for investors. I think since launching MXT and MOT on the market, we've now been able to demonstrate to the market that there is actually a different asset class that perhaps delivers a different risk, return and volatility outcome. And it's pleasing when we look at MXT now that it's been listed on the exchange since October of 17, investors can now see what is the level of income that's being generated and what has been the stability of the capital of my investment. What has it traded like on the stock exchange? Has it delivered everything that I expected? And pleasingly, we've seen that now delivered with MXT in terms of lower level of volatility, but a return that's commensurate with the income and returns from other asset classes. MOT was our higher yielding fund that was launched in April of 19, designed to give investors participation rights in debt, but also where we're negotiating transactions directly with companies. If we see the ability to gain upside participation rights for our investors, then we believe that we should try and do that. And so MOT is designed to be the higher yielding fund and vehicle for investors, giving investors rights to participate in potential upside gains through negotiation of instruments like options or warrants, or taking an outright equity interest in a project or a company that we may have lent to. So these are the various vehicles that we operate now, and I put them up just simply to show people that at the end of it, we have a process here that allows investors to gain exposure from very high investment grade credit through sub-investment grade, but our funds also give investors the ability to participate through the capital structure. So when I think about the general market, people often make references to sub-investment grade loans or sub-investment grade debt as being junk. I guess what I would say is they fail to understand perhaps the benefits that are available under Australian corporate insolvency laws to a secured creditor. And so we believe that there's a range of things that you do as a lender to structure, to mitigate risk of downside loss, and we have appropriate mandates to deliver that risk and return outcome for our investors. And so these boxes are just simply the way in which an investor can gain access to a private market, have a clear understanding of what is their risk objective, what return are they seeking to achieve, and then what is the liquidity options that are available for them. And so through MXT and MOT being publicly listed on the exchange, we've effectively transformed investors' holdings that were previously in less liquid or illiquid asset classes, now giving investors a means to be able to trade those on the exchange on a daily basis. So if you think about when you lend money to somebody, you'll charge a higher price for the longer term. So if you lend for, say, 12 months, the credit margin might be a particular rate of return. As you increase the tenor, the risk to you as a lender is increasing. So if we're lending for, say, 3 or for 5 years, the credit return or the credit margin that is attached to that loan will increase, reflecting the longer term. Now all of a sudden investors are getting the benefit of that and being able to trade it on the exchange on a daily basis and receiving the income on a monthly basis. So our funds have been designed to give investors choice around what is the risk they're taking, what is the return objective, and how do they best manage liquidity in an illiquid asset class. So this is the historical performance of our various funds. You can see, again, from a more conservative option in our Diversified Australian Senior Loan Fund, delivering close to 5% there since its inception, delivering then up to the higher yielding fund closer to 10%. And again, this recognises that it's not a homogenous market. When you lend to a company or you lend to a project, the risks you take as a lender need to be understood, and then you need to structure the appropriate controls to mitigate that risk of loss. So as a lender, if I think about the asset classes, going back to the asset classes, you sit there and say, equity will always be your most volatile, highest risk asset class that you're investing in. And yet we have a market that effectively buys equities for income with a view that that's their only alternative. And so what we've sought to do to bring to the market was a means to give investors more capital stability through debt, but giving them an attractive income. So capital stability combined with income, we believe is a great option for people that previously had limited choice. So if you go back to pre-October of 2017, an investor looking to allocate capital across their sort of more conservative part of their portfolio, really had limited choice. It might have been a hybrid, might have been a bond, might have been a term deposit. Very limited ways in which you could get diversification. Now, as a result of MXT and MOT coming to the market, we've now seen a number of managers bring quality products to the market, giving investors choice. Now investors have got the choice to invest in Australian corporate debt, international bonds, domestic bonds, high-yielding European and US debt. But the important thing that I think is important is that investors really need to now dig into the asset class to really understand what is it, what are the underlying assets that are held in these vehicles, and what is the risk and the return that I'm receiving, and what is the likely liquidity of those assets. Because not all debt is the same. And so when I think about it, it's just very important for people to understand that when you originate transactions, you can originate a transaction in a very high investment grade quality corporate. The credit spreads that you get in that will be quite low. So if you go back to that particular chart that we showed at the start there, if you think about a range of investment grade corporates, the credit spreads on investment grade corporates will be quite low. As you move along the risk spectrum, the return, the fees, the margins and the like that are charged to borrowers as you move into sub-investment grade exposures start to reflect the increasing level of risk that you take. But as a lender, it's our responsibility to understand the companies we lend to structure the appropriate terms, the conditions, setting covenants, negotiating the right price for that risk to deliver the outcome for an investor. And it's our view that in credit, it makes a lot of sense to be very well diversified. But in terms of the options that are now available for investors when they think about investing in offshore credit, I think one of the things that people need to really do is the diligence around the underlying assets. And so there's a lot of discussion and debate in high yield markets and the like around the weakening in, say, US high yield markets around covenants and controls. As a lender in the Australian market, there are a range of protections that you have available to you to protect your risk from downside loss. And that's through appropriate covenants, appropriate controls, discipline around the way in which a company might be able to release or access its cash flows. So when I think about the world of sub-investment grade debt, and people say, oh, it's junk bonds if you're investing in sub-investment grade. And we lend to, say, a private equity sponsored company that we've provided funding to. In the Australian market, that company will be funded into an SPV, will hold security over the whole of the company. There'll be covenants that will require the debt to be amortised down and reduced over a period of time. There'll be appropriate controls to ensure that the company is generating sufficient cash flows to be able to service and repay its debt. And there'll be covenants that will be imposed to monitor the risk associated with any change in or increase in leverage. And as a lender, there's no distributions to equity. So there's no dividends in those structures. The cash flows that are generated from that company are used to service and repay your debt. So from a lender's perspective, it's not just simply about the credit rating, it's about the controls and the way in which you've mitigated the risk of loss through appropriate structures and negotiated facility documentation to control your risk of loss. And all of that comes down to our team undertaking a deep analysis around the companies that we lend to. So appropriate due diligence. So when I think about lending, say, to an operating company, there will be accounting and tax due diligence. There will be external legal advice that's provided. There's commercial due diligence to understand how the company might perform and interact in its industry, all designed to allow us to dig into the detail as to what are the key cash flow drivers of this business and what is its capacity to generate cash flows to be able to service and repay its debt over time. I think one of the things that's interesting, and I touched on it there before, is the theme, I guess, in terms of the Australian market and why we exist, I guess, as a lender. And I think there are two themes. One, the Australian market is very much a bank-dominated market. Australian companies tend to be unrated. They don't have external credit ratings. And as a result of that, their access to institutional capital is quite restricted. Most Australian companies are relying on banks for debt funding. The Australian corporate bond market is very immature in the context of a large institutional market. So if I think about the Australian corporate bond market, if you strip out governments and financial institutions, the Australian corporate bond market's around about 40 billion in outstandings. And you compare and contrast that to the on-balance sheet activities of the banks, and it's around about $1.1, $1.2 trillion of corporate debt that sits on bank balance sheets. But the Australian corporates, given that they are unrated and that access to institutional bond markets is quite difficult, those borrowers become heavily reliant on the banks for funding. And yet the banks, as we all know, continue to face into increasing regulatory pressure, and they continue to have an increasing cost of funding pressure, which makes them not the natural holders of the corporate loan assets that they once were. And so it's our view that the market needs to develop and other alternative ways need to be provided to provide funding to Australian companies to grow. And so when I compare that, and I compare it now to the experience in offshore markets, if you think about the Australian market, it tends to be a bank-regulated, bank-dominated market. And so the credit risk that most companies are exposed to and what is held on bank balance sheets tends to be a credit risk of A to double B. And they are the kind of assets that sit on a bank balance sheet, loans to companies between those ratings. As they move further down the risk spectrum in the Australian market context, that's almost like go and get equity. But in offshore markets, particularly the US high yield market, it tends to be a credit rating of double B to below triple C. And so now we have products on the ASX giving investors exposure now to the full risk spectrum, from high investment grade all the way through to almost defaulted securities. And so I think it's really important that investors understand what is the underlying nature of the assets that are held in these vehicles and what is the risk that the manager is taking to deliver the outcome and the income that I'm looking for, and what is the stability of capital. And so I think there are probably a number of features that I think are attractive in the Australian market compared to, say, an investor's exposure to, say, US high yield. And that's largely Australian corporate insolvencies. The Australian corporate insolvency laws are very favourable to secured creditors. We have protections that are not necessarily afforded in other jurisdictions that give you the rights and the powers to control your risk. So if I think about lending to a company, we will say that equity needs to be aligned and that equity needs to wear the risk of loss. And so if there's a deterioration in earnings, so we think about now the coronavirus and how that might flow through, obviously if there's a decline in earnings, that will be felt by equity. As a lender, I should have already made sure that there's sufficient equity buffer in the capital structure to sustain and support our position as a lender so that we're not at risk or exposed to the risk of loss. And so you could have a material decline in earnings. Yes, you as a shareholder are going to be impacted as a result of the capital value of the equities that you hold. Your income will then be impacted as earnings decline, impacting future distributions and dividends that are paid to shareholders. But as a lender, it's a contractual obligation that company then has to repay us our interest, to pay the fees and to pay the principal on maturity. So insolvency laws are very important in terms of ensuring your position is protected. Obviously, investing in Australian companies, floating rate exposures in Australian dollars avoids the risk to investors in relation to foreign currency movements. And equally, I've talked about the protections that are afforded to you through appropriate controls and covenants to protect your position as a lender. And what we've seen in offshore markets is that you have seen a reduction in the standards associated with the lending conditions that are applicable to some companies in offshore jurisdictions. So the other thing that I think is that there are a range of things that need to be called out in terms of the differences, one of which is the public nature of instruments that are held in funds versus private instruments. So if you think about investing in, say, MXT or MOT, the underlying loan assets that we hold are not subject to mark-to-market volatility. The largest risk that we expose an investor to is credit risk, the risk of loss in the event of a default. And so as a result of that, you're removing the volatility of the asset or the NAV because the underlying loan assets are held to maturity. And I point that out in that if we're lending, say, to a large company that's completing, say, a residential high-rise development, and we're completing that on a cost to complete on a construction basis, it would be very difficult to turn around and say to that borrower, oh, sorry, I need to sell your loan asset to create liquidity for my investors. So you lend, in the Australian market, you're lending for the term for which you're providing the funding. And so they're not traded, they're not screen traded loans, they're assets that are negotiated, private, and they're held based on core fundamentals of the credit risk that you're exposed to, and we don't trade those assets. And so one of the features that is absent in the underlying loan assets that we hold in both MXT and MOT is the absence of mark-to-market volatility risk, because the underlying loan assets, the biggest risk is credit risk. And so one of the things that we've done in our particular funds to ensure that the market is informed and educated in relation to the risks that we expose investors to is a proper governance process around ensuring that there's an independent party that reviews and assesses, independent of ourselves, the risk of impairment or the risk of loss in portfolios that we hold and operate. I think the other thing that if I look at our vehicles, particularly MXT, we have tried to deliver to investors a vehicle that provides stability of capital, that is highly liquid, can be traded on the exchange, where investors can enter and exit without moving the price. We've tried to do it in a way that you've got exposure to a well-diversified spread of corporate debt. So when I think about MXT, the portfolio is now diversified across around about 140 individual positions. The individual exposure you have to any one individual borrower is around about 0.9 of 1%. So we've continued, as we've raised capital, sought to continue to lower investors' exposure to credit risk by further diversification of the portfolio and providing greater levels of capital stability as you're removing that risk of credit loss. But I think the other things that we've tried to do is give investors access to an institutional quality product on institutional terms. So often I think a lot of LICs and LITs have created problems in that they've been marketed to retail investors with a fee load that is it's more profitable for the manager to perhaps distribute a fund for retail investors, yet the institutional investors might get a better fee deal. What we've sought to do with MXT is that investors investing in MXT pay the same fees and costs associated with the very largest of an institutional investor. And so I think that was a unique feature that we brought to the market when we brought that particular product to the ASX. But the proof's in the pudding in terms of really what's happened in the last couple of weeks in terms of volatility. The underlying loan assets that we hold should provide for stability of capital. Not only are we looking for a highly liquid, tradable instrument on the exchange, giving people daily liquidity in a less liquid asset class. We want to pay income monthly, so investors have got the ability to get a predictable, known income on a regular basis. But we also want to preserve and protect their capital from fluctuations in the market. And so from our perspective, informing the market around the daily NAV, ensuring there's proper governance processes around the way in which those assets are valued and tested for impairment, can give investors confidence that when you're buying MXT or MOT, there's an appropriate governance structure around it to ensure that your interests are protected. And I think the thing that we saw was the absence of mark-to-market volatility risk flowing through our funds, the clear understanding in terms of investors' understanding around the risk and the defensive nature of loans. So if you've contracted to lend $1 to somebody, you'll receive the interest and fees associated with lending to that company, and the obligation is on the part of the borrower to repay you on the required date. There's no subjectivity, there's no variability. You invest in an equities LIC or an equities product, you're always going to have a degree of subjectivity as to the valuation of the underlying assets on a day-to-day basis. There's no subjectivity when you lend money to a company, and that should be then reflected in the carrying values of the portfolio. There's a range of things that we'll talk through in the Q&A session, and I think a number of these things are features that are relevant. The effect of low interest rates, so the underlying loan assets, for instance, that we hold in MXT, predominantly floating rate. Floating rate is a means to protect investors where interest rates might rise. So in a rising rate environment, if you're in a fixed rate bond fund, for instance, the capital value of that bond will be impacted. In a floating rate vehicle or a vehicle where most of the underlying assets are floating rate, Obviously, a decline in the base rate will impact investors' total returns. So obviously, as the RBA cash rate flows through, that will lower the total return to investors. But what we're looking at is how we manage our portfolio to deliver better sources of income for investors. And those sources of income come from fee income, and they come from appropriately charging margins, credit margins, based on the risk that you take. And so I would always say that the fee income that you're able to generate by charging a borrower an upfront fee is a far better source of income for investors than simply relying on the interest coupon that's available to you. The regulatory headwinds for the banks, that's just a continuing theme for our business. So as the banks continue to withdraw capital from certain sectors, we continue to see good opportunities to lend to companies. And so as a business at the moment, we sit in a position where we have around about $5.5 billion of assets under management. That's capital fully deployed. We run a pipeline of around about 2.7 billion of new transactions that we're looking at. Across our funds, we do between 100 to 150 million every month, just in terms of recycling and redeploying the capital of companies that have repaid us. So as a lender, it's our view that you lend for shorter periods of time. You want to provide benefits to your investors through shorter dated exposures, and those shorter dated exposures reduce investors' exposure to credit risk. Obviously, if I'm analysing and assessing the credit risk associated with a company that we're looking to lend to, I can have a far greater degree of confidence around the performance of that company in a shorter period of time than, say, over a 10-year period of time. By lending for shorter dated periods, you've reduced the market risk. So volatility of credit spreads is going to be a thing that will reduce the risk to investors. As a result of the churn of the portfolio, it gives you the ability to charge fees on a more regular basis, driving income for your investors. So all of our activities are designed to provide our investors with exposure to a well-diversified, well-structured, well-managed portfolio of credit assets, delivering stability of capital, but delivering attractive returns that are uncorrelated with other markets. And I would say, a large part of the ability to deliver income for investors through our asset classes is the skill set of the manager. If you're passive and you wait for a bank or another party to deliver an asset opportunity to you, or a bond or an equity, that you're going to receive the income and the outcome associated with what's been offered to you. If you're out there in the market looking for opportunities to drive return and deliver outperformance to your investors, you're going to be driving the fee negotiations. You're going to be looking to do things to mitigate the risk of downside loss through appropriate covenants and structures. And so from our perspective, we would always say you want to bring your investors closer to the point of origination, where the transaction is first entered into, because it's at that point where fees and charges that are applied to the borrower are greatest. And so as a result of our activities, we believe we bring our investors closer to that point of origination, where we think we can maximise income for investors through not only the interest coupons, but also through fee activities that are charged to borrowers. The impact of the coronavirus, I think we'll go through in a lot more detail through the Q&A session, but I think it just comes down to, again, fundamentally understanding where you sit in the capital structure. Obviously, there are going to be impacts through the broader economy as businesses are impacted, but again, that risk as a lender should be borne by equity. So as equity is your buffer for loss. So if I think about the asset class, equity is your asset class you're investing in for capital gains and growth in earnings. The debt part of the capital structure should be the lower risk part of the capital structure to protect your interests as an investor. So it's the part of the asset class, and in our market, you can certainly, if credit quality was to deteriorate and impact the value of equity, you can burn through a lot of equity before you as a lender have even lost $1. And then at that point in time, you've got a range of things that you can do to mitigate and control your risk of loss. take control of the company, that then may actually provide investors with upside participation as you pursue ongoing recovery actions and the like. So we can talk about that, but I think the main thing here is to understand that that requires a degree of diligence around the way in which you assess and manage credit risk to avoid things like downside risks associated with coronavirus. It's actually interesting. I always think Don says it very well, avoiding dividend traps. For us, that's just avoiding situations where companies' equity value is deteriorating to a point where it might actually impact us as a lender. So in the same way, Don tries to deliver income from stability of his investments and the equity positions that he holds. For us, the stability of the capital should already be protected from those substantial potential declines in equity value, delivering greater levels of stability to investors in relation to the underlying assets that we hold. So I'll leave it at that and look forward to the Q&A. Thank you.
Thanks, Andrew. Don't go anywhere. Don, if I could get you up here as well. Andrew, you spoke a little bit about the fact that you guys were the leaders in bringing fixed income to the market. There's been a plethora of other offerings out there since you listed the MCP Master Income Trust 2.5 years ago. Do you mind just giving people a bit of an idea on how MXT and MOT compares to some of those competitors?
Sure. I think what's generally happened is that investors now have a range of choices, and those choices have allowed investors to gain exposure into offshore markets. As a lender, I would always say to you that diversification in international equities is attractive because there are a range of industries and others that you may not get exposure to. And from the perspective of looking to gain capital growth in your investments, that makes a lot of sense. But in the Australian context and in credit, I think you actually want to be invested in the most favourable jurisdiction in the world. And as I pointed out before, Australian corporate insolvency laws are very protective of the interests of a secured creditor. And so as a result of that, I don't believe that diversification in offshore markets is relevant when it comes to credit. I think capital preservation and delivering acceptable income levels is what's important from a lender's perspective. I think the other thing that is important to understand is that most of these competing funds, I guess, are giving investors exposure to public market securities, where the investors will have some exposure now to not only credit risk, but you'll have greater levels of potential variability of your holdings based on the mark-to-market movements of those publicly traded securities. So I would expect that you'll see more volatility in the unit prices of some of the competing firms or competing funds. I think the other thing that I would just point out, and we tried to do it deliberately when we brought MXT and MOT to the market. I think it's really important that the target return that you're seeking to deliver to an investor represents and reflects the expected risk that the investor is also exposed to. So with MXT, we said it's part of what we would see as a traditional fixed income asset allocation decision for an investor. So the RBA cash rate plus 3.25 gives people confidence and an understanding as to where that might sit in a portfolio. MOT, we said, look, we're taking higher risk. We think your capital that you invest in MOT is precious and should drive for upside rights to participate. So if we're lending to a company and we see that the value of the loan or the capital that we're providing is actually going to provide for earnings growth and a potential capital gain, then we seek to negotiate the right to participate in that upside gain. So MOT was designed to be more of a replacement for equity. So again, a lot of investors investing in equities for income. We think we can deliver you an equity-like income through investing in debt, and MOT was the vehicle. So we tried to have two clear, discrete target returns reflecting the risks that are in the different portfolios. Since we listed MXT and MOT, we've seen a range of competitor funds come to market that have very consistent return targets like MXT. And you dig into the detail of those underlying holdings, and a number of them are investing in US high yield. As I pointed out before, US high yield market is BB to CCC or lower, so you've got a materially lower credit quality delivering you the same return as, say, an MXT. So I think investors should be encouraged to look at the target return but also then dig into the detail as to what are the underlying holdings and what am I actually exposed to, and is that investment really generating the return that I should be receiving for that risk?
Thanks, Andrew. Don, equity income's certainly no new asset class, but the way you guys do it is quite unique. Mind just taking everyone through how your approach differs from the likes of the buy-right strategies or the permanent buy and hold, high-yield strategies which are permanently overweight the banks or Telstras and high-yield stocks like utilities, etc.?
Yeah, well, as I said, the way we do it is we actively move around stocks to capture dividends, rotate. Wouldn't call it dividend focused, I'd probably call it dividend rotation. But a lot of our competitors, and some of them are no more actually, but quite a few of our initial competitors were I would call buy-right strategies, which you buy the stocks, you write a call option over the top of the stock, because when you sell a call option, you get some income, extra income. So you get the dividends from the underlying stocks and you get the income from writing a call option. But there's no such thing as a free lunch. You sell someone a call option because you are selling them something. They pay you money because they get the upside if the share price goes up. And to me, a lot of people put money into equities because there is upside. There isn't a lot of capital upside in debt, but you get this good solid income. But you go into equities because the equity markets over time tend to go up. And if you are selling all that away, yes, you're getting more income, but actually you're not getting nearly as much capital growth. And last year when the market went up 24-25%, if you sold all the upside or most of the upside, 10% income and no capital growth doesn't look all that attractive compared to a market that went up that strongly. The third one is really, and this is what you can do it yourself, buy a couple of banks and Telstra, they're the big income stocks, but you have the biases of the sort of sectors. And globally, whether it's globally or domestically, the big income stocks tend to be financials, tend to be banks. In Europe, it tends to be utilities as well. And you can stuff your portfolio through Italian banks and Spanish utilities, but I'm not saying that's a great way of doing it. So we believe actively rotating means you can actually have a place for some CSL in your portfolio because you're rotating through to get enough income off the other guys. You don't have to be overweight banks or utilities or Telstra.
I found it fascinating, that chart you had where the banks and Telstra had underperformed by plus 30% over
the last couple of years. Yep.
Okay, what I really want to do today is spend a bit of time on Q&A, so you guys get the opportunity to ask Andrew and Don some questions on their approach to income investing. I'll kick it off. The obvious question at the moment is, how is coronavirus impacting the way you're thinking about portfolios? Andrew, I suppose, how are you guys looking at it from your perspective?
Yeah, as a lender, as I said, that should really be borne by equity. And so from our perspective, obviously we'll be concerned as to the potential impact or the decline in earnings and how that might impact our borrowers. But from a lender's perspective, there are a range of things you should have already been doing. You don't want to be exposed to industries and borrowers where there's great degrees of cyclicality or risk in terms of cash flows and earnings. Or if you're exposed to that, you need to make sure you've got a very tight covenant and control suite. So I think for us, we would look at traditional groups like, say, tourism industry, and we would say that's a much more cyclical industry. Therefore, for us, that's not a terribly attractive industry to have exposure as a lender. If I think about industries that are perhaps more challenged in structural decline, that's again an industry groups and companies in those sectors that are less appealing as a lender. Things like education or, say, even student accommodation, fine from an equity perspective, but as a lender, you're looking at it and saying, well, okay, when we look to lend to this company, we realise that we're heavily exposed to the risk associated with foreign student inflows. As a lender, is that sufficient diversification of the sources of revenue and cash flows that are going to support the debt repayment? So we've been very conservative in that area. We have no education exposures. We have no exposures to the student accommodation sector either. But that largely because as a lender, you're looking through what are the risks that you could be exposed to. And you look to make sure you've either avoided those altogether or set appropriate very low levels of debt so that equity wears the risk and wears the pain if earnings growth don't materialise.
Don, I assume similar sectors that you're looking to avoid?
Yeah, I mean, obviously the ones that are likely to be most affected are tourism, airlines, hotels, anything associated with that. But I say that, you don't logically think Blackmores is going to be affected by this, but they sell a lot to Chinese and Chinese aren't allowed in. And Cochlear is an interesting one. It's not just Chinese hospitals, it's basically hospitals around the world if this thing perpetuates. But the beauty of us is, Andrew says, well, we don't go there at the start or we have protection around it. But in our case, we're a very active portfolio. We can sell Qantas. We don't want Qantas. We don't want hotels. Just don't go there. Or if we are there, sell out and we go back in when it's safe to go in. I think I might have said, but we've in our portfolio from historically, we've actually not owned Qantas more than when we have owned Qantas. We don't have to own every stock in the market. We want to buy stocks that pay good dividends. So that dividend trap avoidance is very, very important, and probably more so in the next 6 months. But I mean, the numbers suggest that maybe the first day actually is the first day that we're seeing some slowdown in the global numbers coming out. So hopefully we may be past the peak, and as things warm up, I think we'll see the things getting better.
Given that you've got all the caution in terms of who you select to lend to, I'm presuming there must have been some failure along the way. What has been the worst, if at all you can tell us, in terms of the experience of who you've lent to and have become bad with it?
Oh, look, we I guess have had, I guess myself and my partners have been doing this between 30 and 40 years. So that saw us coming through, the 87 stock market crash, the recession, range of different things. If you think back even to the GFC or the most recent 2015 commodity prices falling, as a lender, there is a range of things you do. The company is often required to raise equity. If you don't raise equity, you'll be forced into an asset sale program. If you don't sell assets, we'll sell the company. If you don't sell the company, we'll enforce our securities and take control of the company. So as a lender, if you think back to, say, 2015, commodity prices fall, what happened in the market? We had deeply dilutionary equity raisings undertaken. So we had groups like Santos and Origin Energy and others do deeply dilutive equity raisings, destroying value for shareholders, raising capital and using that capital to restore their balance sheet and repay debt. If we look at the GFC, you had examples of Wesfarmers, Rio Tinto and a range of other large companies that did exactly the same thing. So the same applies in private company debt, that you're lending to private companies. It's about, well, have you got the capacity to raise additional equity to use that to repay part of the debt? Or are we going to see assets being sold to repay the debt? Or are we going to sell the company as a whole to repay the debt? The issue for you as a lender is you want to have those discussions triggered as a result of a breach of a covenant well before you've got a monetary payment default. So all of the positions that you should be looking to do is taking proactive action as a lender well before you've lost a dollar and well before the company is not generating sufficient cash flows to be able to service and repay your debt. But I would say probably for us, the worst experiences we've had since establishing Metrics was lending to a services-based company. And that's demonstrated yet again to us the conservative nature associated with lending to services-based businesses. The value of your position can deteriorate very quickly. In that particular case, we completed a debt for equity swap. We continue to hold the position as equity. The business continues to trade, continues to perform, and its performance is now starting to gradually improve. And so as a result of that, yes, we've taken a reduction in the carrying value of our asset, but over time, we believe that not only will we recover the full value of the debt, but we potentially outperform that as well.
Andrew, you mentioned how you'd handle those bad cases. The quantity of bad cases that might fall on your desk in a smallish company, could it become too much?
No. I guess the issue for us is that, so we're invested across around about 150 individual companies that we've lent to across our portfolio. The team is continually built. We now have 60 people in the team. You've got to remember that the portion of your exposures that are in, say, higher risk transactions will be a very low portion of your overall portfolio. And so what you tend to find is that, I guess for us, you have to monitor the risk on a day-to-day basis. companies, private companies that we lend to, or property development groups that we lend to, have obligations to report, and they are monthly reporting. So you stay across the detail on an ongoing basis. So across our business, we say that we've lent in excess of 300, completed in excess of 300 transactions. In that period of time, we've had 2 transactions that we've had to go through, work out or restructure of. One, we made a lot of money for in relation to that particular transaction as we work through the restructure. The other one has cost us, but hasn't cost us to the point where we don't believe we'll recover over time. So again, this is a little bit of the difference. A lot of people that are in a bond fund, people talk about credit risk asymmetric. In other words, whatever happens, it defaults, you've lost your money. It's not that. It's not asymmetric in our world. Our world is if a company goes into, if credit quality deteriorates or the financial performance of the company deteriorates, you need to take a proactive stance to manage and work through that restructure or work out the credit to maximise your potential upside recoveries over time. So if you think about it in the context of a bank often puts itself into a position where they become a forced seller. So they've got regulatory capital that's required to be held against an asset. If the credit quality of the borrower deteriorates, the level of that capital that they're required to hold against that asset increases to the point where it becomes very costly and expensive for the bank to continue to hold that asset on their balance sheet. At that point, they almost become a forced seller. So if you think about a bank, they're going through a restructure of a company, banks won't be holding equity in restructured companies because they're 400% risk weighted. And so there are a range of regulatory controls imposed on banks that really do limit the way in which a bank can go through a restructure or a reorganisation of a company where it's got itself into financial difficulty. That's why the banks tend to sell the debt and sell their debt to funds, and then those funds go through the restructure process looking to maximise recoveries.
Okay, any more questions?
James. Can I just add on that? I should just add. Just one really important thing is we as a business probably complete between 25 to 30% of all deals we would see. So in terms of reviewing transactions, doing the diligence and actually completing it to the point where we provide the funding, it's around 25 to 30% of completed transactions.
James, you had a question?
It's for Andrew. This is on MOT. So the share price has dropped from about 209 to 197 over the past couple of weeks, and NAV's 201. So is that coronavirus related, and do you think it's been overdone?
It's just market liquidity. MOT is a little bit of in a little bit of a different position because we raised 300 million was what we completed the IPO on. So it's a much smaller fund. It doesn't have necessarily the great levels of investor diversification that we would like to see. MOT, we've got a much larger vehicle, large spread of unit holders, and the liquidity of the traded vehicle is much greater than MOT. With MOT, it doesn't. The trading performance on market doesn't reflect the value of the underlying portfolio that's held. So there's the underlying portfolio. We subject ourselves to an independent review by, we say in the PDS, one of the large international accounting firms. They do that on a monthly basis. They review the valuation. They look at the way in which we complete our credit assessment, the way in which we rate the credit, and then they test for impairment. They test for impairment today, and they have a forward-looking view in terms of impairments that might flow through the portfolio at a future point in time. So that was last completed as at the 28th of February.
Okay, other question? Just in the middle there.
Question to Don. Just wanted to reconfirm that Plato is still a retiree-focused fund, and you're still using the buy 60 days before and sell later on to get the credit. Be able to do that fund process.
We're definitely retiree-focused and very focused on the franking credits. I mean, we don't religiously buy 60 days. Sometimes we buy earlier, sometimes we buy later. But yeah, no, 45-day rule is still very important, and retiree-focused, which I think is a feature of our fund. There aren't many that are like that. There's one over here.
Thanks. Don, just you've retiree-focused, but you've mentioned the teams invested in the fund. Can you quantify the tax impact of your strategy?
Well, I mean, myself personally, and a number of the people invest via their superannuation funds, but they're at 15%. But the reality is, okay, you don't get a full refund of the franking credits, but you actually get most of it back. And in fact, maybe I might have a fund that doesn't pay any tax to the tax department, but that's the way it is. So it's still very tax effective for low tax investors. Most of them would probably have it structured so it's not in the high tax end, but it's more in the superannuation type stuff. It's been very efficient from a CGT point of view, because the reality is we buy cum dividend, we sell ex dividend, the share price falls. So we haven't actually distributed any realised capital gains since we started. So it's actually been there. But just think about it, if you've got so much income coming out of your fund, your capital gains will be lower than, say, a growth manager which pays very little income out, and they might have the same total return, but they've got massive capital gains. So they're far more likely to pay out more capital gains, whereas ours, nearly 10% income distributed, then it's pretty tax efficient even for taxed investors.
Okay, I've probably got time for one last question. If anyone wants to dive in. Okay, look, we might leave it at that. Our aim today was to showcase some of Australia's leading minds in income investing. And I think you get that with Plato on the equity side and Metrics on the fixed income side. One of the key takeaways I always take out of sitting and listening to our managers is you can set a really tight expectation with both these fund managers. Plato, the total return is going to be like the index, but you can look at the consistent way they generate the income. They've been able to generate 9% income year in, year out, which is 3% above the index. So you can set a really tight expectation with total return and the income level. And Andrew and the Metrics team really provide that capital stable investment, but also provides that consistent monthly income over a portfolio of corporate loans. Andrew and the team came to the market 2.5 years ago with a portfolio of around 60 loans. That's now diversified to over 150 loans, and it's also reduced the fee that you get. In terms of the offerings that both Plato and Metrics have, you can access the offerings via listed investment vehicles, as Andrew and Don both mentioned, and then unlisted funds. Andrew and the Metrics team are about to launch the Metrics Direct Income Trust, which will be a way you can access a version of MXT on platform, and we'll be going through the process of getting that fund rated and on platforms over the coming months. We'd certainly like to thank you for your time today. We will be sending CPD points out in the coming weeks. We've partnered with a group called Portfolio Construction. They'll be sending that out. And then you'll also be able to access the presentation today on our website, dedicated website called Pinnacle Masterclass.com. So thank you very much for your time today. Thanks, Don and Andrew, for your presentations. They're always fascinating. And thanks for coming out in this hard week in terms of weather and equity markets. So thank you very much. Have a great day.